Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, February 23rd, 2016. Let's take a quick look at gold and the miners. I had a good question put to me today. It's on the front page of the site. My response is below. It's from under the post U.S. dollar GLD USO Outlook MR5 MRG5A user MR5GA asked, would I consider reversing my positions going long GDX if the chart happens to be a high tight flag pennant? And that's, he pointed out this high tight flag pennant right here. You can see the flagpole, the sharp move up in GDX, which I've certainly noticed. And that would project, if you take the measurement of the flagpole, add it to that flagging action there, put it at the lowest point, and that would be your measured target. So, very powerful. And, and something I say often in trading is that the weekly charts, this is something you often see on the intraday charts and daily time frames, but flags and all technical patterns work equally as well on all the different time frames. So that is a possibility, especially the fact, I've talked quite a bit on the markets, and we still can't rule out that primary third wave down, that this, we recently had a corrective wave 2 up in the markets, and maybe the markets are due for the next powerful move down that takes out the lows. And if that happened, we probably see a continued flight to safety in gold. And if gold goes up just as sharply, then the miners go up. So that is certainly a possibility. However, as I stated in my reply, it's just not my trading style to chase something so overextended, and I'll list the reasons here why I wouldn't be going long if we break to the upside of this, which, so far, if you really zoom in, we've now taken out the top of that recent, and this is just a weekly here. We're looking at 2 weekly candlesticks. This week hasn't closed out, but you can also view this on the daily chart and you'll see the same thing. So you can look at any time frame you want. And again, that is certainly a possibility. It's just there's plenty of other fish to fry, and I wouldn't be chasing the miners, not just yet. And I'll show you why in this video. All right, so let's get rid of that. Okay, and while we have GDX up here, again, this is a 10-year weekly chart. Let's look at a couple of things. The bullish case has been made for a long time coming, and I just underestimated the scope and the magnitude of how explosive this rally would be. Even though I for a while talked about an explosive move into gold and commodities with all the liquidity sloshed around the financial markets, but whatever, hindsight's 2020. My original plan stated back here was to, as soon as we saw evidence of a bottom, was to tuck away a dust short and just lock the key up and throw it away, and let the same thing is likely to happen to dust over the next year or two or plus that happened to Nugget from this point. I put that chart up in the trading room several times. If you look at Nugget from its inception, it's down 99.7%. Obviously, the miners, the GDX, and Nugget actually came out during the bull market, still, had a way to go up to the top. So it's not like Nugget came out right here at the top. So that just talks about the decay I often mention. All right, let's move on and just talk about really right now what's going on in the miners. Long-term chart, I mentioned this quite a bit. This, the 9 EMA, I use a PPO, which is very similar to a MACD, but it works better on these longer-term time frames. And just as with the MACD, you can use that signal line on the PPO, the white line, and it does just a great job of defining bull and bear trends. So you can see here, this is a 10-year chart leading up to the end of this bull market. At this point, that 9 EMA was positive, and it crossed over bullish right here, indicated that the miners were likely in a new bear market, and that was the case. It caught the bulk of that bear market, and then it told you at this point that the bear market was likely over with that bullish crossover. And look how well it doesn't just cross. It's not just the crosses. You can see, not so much in this case. I'll get to some other stocks in a minute. But often when tested from above, it bounces off that zero line until, boom, you had a bearish crossover. It said we're in a new bear market. One slight whipsaw signal there, but really it was almost a back test of that zero level. Came up, another back test, and this is what I'm referring to here. So it really defines a trend. And where are we now? We've yet to cross over. So again, there's a lot of evidence, and I do believe that the lows in the miners was most likely in at this point. I do believe that, and I think that's the start of a new bull market. We haven't seen anything we've seen some powerful runs in GDX. I talked about it along the way. That's the nature of the beast. But at this point, the only thing that rivals this move up is the move off the 2009 lows, and this one actually is even more impulsive in such short order. But I'm not trying to use doublespeak here. There's still some indicators that point to this as being just possibly another bear market rally. We don't have the PPO crossing over. That's one sign there. Not shown, not highlighted here. I don't have the arrows, but let's look at all these bought readings. Same way I was making the case all along with these oversold readings and the bullish divergence at the bottom was close. You know, a pretty valid sell signal is the looking at these oversold readings here. This one you had a divergent high, prices making a higher high. So you had a double tap of that level. The second one was a little bit lower, and that marked the top. We fast forward. These came close. They weren't exactly there, but very close, and you can see a heck of a correction in GDX. This one did hit the oversold level right here, and there was. It doesn't look like a lot because this is a weekly chart. Let me just try to. I'm hitting my crosshairs at the high of that peak where that level occurred right here. If I do it there, I grab the trend line. Well, you know what? I'll move that. Okay, this is what I'm trying to show you. As little as it might look on a log scale that I'm using here, if you look to the left, that's over a 17% drop. So again, I don't take these, those oversold readings lightly. Oversold, boom. Especially in a bear market. That's the thing. When you hit oversold in a bear market, if this is still a bear market, we're not quite there yet, we're close. Those are usually very powerful sell signals. You have usually another big leg down. Again, the downtrend line has been taken out, resistance, a lot of signals that I use. In other words, there's not one all or none, okay, we're in a bull or bear market, but the evidence is rapidly mounting that a new bull market is likely underway, but it's just not there yet, at least not by the longest term metrics that define the primary trends on the daily, or I'm sorry, in the weekly chart and even the monthly charts. I've covered that one in different posts. All right, so that's that. Now let's look at gold real quick, and then I just want to get to the top three holdings of GDX. That's, I think, really what I wanted to do this video on today is look at those. A lot of this stuff has been covered already. But here's gold. Same thing on the PPO. Look how well the white line, the 9 EMA, has defined bull and bear trends. Remained above in the bull market, crossed over here. Had a cross, a little whipsaw signal, and then confirmed again bear market there. And you can see, as I mentioned here, look at all these back tests. This point here, the 9 EMA came up, rode along the zero line, never crossed, fell back down. And where are we today? There's that 9 EMA just below the zero line. So gold, although yes, this is very bullish, the fact it's taken out that line. However, we're struggling with it. We're really flagging right on it. We're flagging right on above it. We've fallen below, crossed above, below the last couple weeks. So we're not safely out of the woods yet to say, okay, this has been a solid and sustained breakout. And as I often talk about, another thing that gives me pause is breakouts of solid, well-watched resistance level, from my opinion, over 90% of the time fail when you have a very strong move leading up to that breakout without any consolidation below. So in other words, had we gone up here, it tagged that trend line, pulled back, base, consolidated for a few weeks, couple months, and then reset these overbought conditions, that would give us impetus to break out, have a sustained breakout. Now we broke out above it, we're flagging, so yes, glass half full, you say, okay, we broke out, we're flagging, there's our consolidation, another thrust up. And again, this is likely, what happens here will be tied to the broad markets, more than likely. If we had a meltdown in the financial markets, gold is probably going to continue to catch a flight to safety bid. However, if the markets hold up, I made a case the other day, and it's still, we have those bullish divergences in place. The broad markets could hold up here for a few weeks, possibly a couple months, and if so, you'll start to see this bubble or this risk trade, flight to safety in gold deflate. And I'm going to get to some potential pullback targets here in a minute. But again, this is what I'm trying to say is, and this is why I wouldn't chase a breakout just yet in the miners, even though they're eked out to new highs today, new recent highs, is these longer term trend indicators remain bearish. So if you're chasing a breakout and this proves to be either a bear market rally, then the miners have a lot more to go down. But even if it's just let's say the miners need to take a breather now, and gold needs to take a breather and come back in, then we have quite a way to go. Let's go back real quick to the weekly chart of GDX. No, actually, let's move forward and wrap this up relatively quickly in this video. What I wanted to cover today were the big three. As I often state, an index or a sector, or in this case an ETF that tracks a sector, such as GDX, is simply the sum of its parts. And by that I mean, we can look over here. I have a watch list, all the related items. This is all the components of GDX right here. Nice feature, TC2000, and free. I don't know if Free Stock Charts has that or not, but TC2000 has it. You click, and there's all your holdings. And I always sort these by market cap. I can sort them any way I want, but I like to sort them by market cap. So this is what we're going to cover today. Just the top three. Reason being, on another screen right now, I'm looking at the GDX top holdings directly from Market or VanEck's website. That's the fund company that owns or runs GDX. And let's see here. I just had it up a second ago. Okay. Barrick Gold, percent of net assets, 7.78. Newmont Mining, 6.92. Gold Corp, 6.54. So these right here, you can see they're the largest three market cap, and not coincidentally, they are also the top three holdings, and they make up collectively over 21% of GDX. So 1/5 of the returns of GDX comes from just these three big top weighted stocks. So that's why we're going to look at that. Where those three go, undoubtedly GDX goes. GDX isn't going up another 30% without Barrick and Newmont and GG confirming that. So let's take a look there. We'll spend a lot of time on this ABX chart, Barrick Gold. It's the top holding, and then we'll go down and touch on the other two real quick. And this, again, speaks to the reason why I'm not chasing any breakout in the miners, not just yet. Major resistance. You can see this is a weekly chart, 10-year weekly chart. That is a significant reaction low right there. And once that level, we had that reaction low, once it broke, that level was tested for months, many times. Look at all these weekly candlesticks, numerous reactions there. So not only are we at that resistance level, but Barrick has come up an unprecedented, in just a matter of a couple months here. How far did we go to get there? Over 134%. I didn't even catch the lows. So right there's a low, and yeah, about 130. Okay, give or take. It looks like I just missed a low there again, without even a breather. I should say at this point that was the initial rally, and there was a base. So we did have a base. Let me do this a little more representative, if you will. It was really okay. So call it an 80% run out of this consolidation from the bottom of there, without even taking a breath, meaning a consolidation. Any move. This is a bear market in Barrick. You have a major leg down, you have consolidation. Next leg down, once that consolidation zone breaks, consolidation. Major thrust down. This is how stocks work, and you don't see. I would be shocked, stunned, and I would be glad to sit by, and I'll have zero regrets if Barrick just continues on and matches this measured move here. Because for GDX to do that, as we just talked about, we're talking about, you don't see the flagging action here so much on Barrick. You do see it on GDX, and again, you take the measurement of the flagpole, add it to the breakout. That would be your expected move. Is it possible? Anything's possible, especially, like I said, if equities completely melt down here and there's just a crazy flight to safety into gold. However, let's look at the indicator. So already, I made my point here at resistance. Longer term bullish case, there it is. Barrick, like everything else, this is a major bear market downtrend line. That was very bullish. Once that was taken out, we just blasted right by it. So that is, that is longer term bullish. But now let's look at Barrick real quick over here. Let's go down to the bottom and look at this, the PPO. Here's that 9 EMA, and on this level I did put a green arrow where the bullish crosses were, so you can see it, and I'll just put my lines on those green arrows. Let's get that away. All right, get the box away. So you can see, okay, it gives you a buy signal here, bull market. And again, don't underestimate this chart because I'm using log scaling. That is well, of course I removed the stupid box. Let's put it back. From that point, it captured a 90% run. So again, that's almost a double in the stock. That was an excellent buy signal. And at this point, it said, right there's the cross, bear market has started, get out. You avoided this big meltdown that, didn't get you in at the top because they're not exact timing indicators. Back here it said, okay, safe to get in, the bear market's over. There's your trend. Look how the trend remained bearish. It flirted around with that zero line, then it crossed over here. It said Barrick is now in a bear market. Get out. Stay out until this white line crosses over. We had some nice rallies along the way. It looked like the real deal, but no, we rejected. You can see this white line rejected again on these attempts. So this told you from this point on, stay in a bear market. And why do I have question marks here? Because this is a weekly chart. Yes, that white line is slightly above, but today's Tuesday. And the only thing that counts is where this line is on Friday. So in other words, that white line could close up above there, and that would be an early indicator that, wow, okay, maybe this trend has some staying power. But it could also fall back below there. So we'll see. We'll revisit this, or at least I'll be looking at this on Friday to see where Barrick and some of these other guys close. All right, so that's that. We're, again, at major resistance with the 9EMA, which has done a great job of defining bull and bear trends, testing, still in bearish mode until we get that weekly close over there. We haven't gotten it yet. So that's reason number 2, which gives me pause and why I wouldn't chase a breakout in GDX, because if Barrick doesn't take out this resistance and falls back under there, it's going to be ugly. RSI, over just the same case I've been making for quite a while now. Every time I highlighted these oversold readings have produced great bounces even in the bear market. Now, overbought readings, these red arrows, you can see we had a divergent high here. So we had this first overbought reading, and you might say, well, that one got you in early. Prices didn't fall to the second one. Again, let's move that line away. From that point where you hit overbought on the weekly, I got to put my tool back on there. It warned you or got you out if you sold right on that weekly overbought reading, 22% drop. So that's, by most definitions, a bear market. In the miners, that's just a run-of-the-mill move, 20-something% drop. So there it is. So oversold again, overbought. We became overbought at this level. Again, don't minimize that move. That's probably 15 or so percent. I'm just eyeballing it. We don't need to measure everyone out. And it also, you can see it was dead money. It marked the top, really. When that oversold reading came, you might say, well, it didn't do anything. Barrick never went higher again. That was the end of the bull market right there. These were just successive taps of that level trying to retest those highs. But Barrick really never broke out from that level. So from here, that's the bear market, and that signal right there on the RSI told you that. And never again did it see overbought, until now. So here we are, once again, overbought. 10-year chart, and history tells us that going long while the RSI is overbought is just as, I don't want to say foolish, but as risky as to going short when it's oversold. These green arrows, you see the bounces here. You can do these on your own chart. Here's another oversold reading. This is a cluster, a double tap. We had a bounce there. So that's what I'm looking at, guys. It's just overbought bear market trend at major resistance. When I say major, because I'm looking at numerous reactions. And this is a very solid resistance level above if we punch out 1545. And then ultimately, I think that'd be the next target after that. So there's my case, and that's why I'm not chasing it. And like I said, those stocks can go to the moon without me at this point, and I'll be fine with it because there's plenty of other things out there to trade. I won't spend a lot more time beating a dead horse here. It's the same story. You can look here. I don't have all the arrows marked, but it's the white EMA bearish trend up to that point. Let's get that box gone. Bearish trend. Bearish, a bullish crossover. Told you a bull trend, which it captured the bulk of. Bearish crossover right here. And look how that white line stayed well. It had a little whipsaw here. I got to give it on Newmont. It did trade under and then came back up there. Got you in for most of the move up to the highs and then said get out and stay out at this point. That's where it crossed down. And you can see look at these tests from below the zero line. 1, 2. Newmont had a little whipsaw here, but it went back bearish, and now it is just like Barrick. It is trying to regain that line, but we haven't done so on a weekly closing basis yet. The overbought readings down below, oversold, were your buy signals. Each and every one produced or was followed by substantial rally. And when I say substantial, they're usually 20% or more. In the same way, these oversold readings, this one, like we had a nice a divergent high. We had the first overbought reading was right there, and again a very significant correction, probably 20% or so in Newmont, followed by another overbought reading. And when you get them two in order like that, then you have the divergent high. The divergence on the weekly charts are just screaming sell signals when you have these divergent tops. And you had it as well on the PPO over there, and that marked the end of that bull market and a new bear market. There we go, overbought. What happened? Boom, that marked the top of the bull market and the beginning of a new bear market. These were near overbought signals. If you look closely, we didn't quite get all the way up to the 70 level, but that's recently. You can almost put a horizontal line there around 66. That's where those previous rallies stopped before. That one, there was a nice correction there. That one, nice correction there. And that's about where we turned down so far, and the RSI is pointed down. You know, Newmont, I have a major resistance zone. If we really hone in, we have, let's see. You can look at the reactions, why I have a zone. We have reaction highs here on this lower line. We have reaction highs on the upper line there, lower line. So there's a few candlesticks, and that's why I have a zone. So I could see the possibility of Newmont punching up a little bit higher. But to get above the top of this resistance zone, especially as overbought as we are, I think overbought is quite unlikely. And race is a chance. All I'm trying to get to here is if GDX does break out, make a little punch up through here, unless the market goes in full-blown meltdown mode. And in that case, you got to be careful, because I've seen cases where gold rallies, and when we have some real selling, everything's getting liquidated in the market. The miners sometimes will sell off with equities, even in spite of gold going up. I noticed that happen in the last bear market, so just something to be careful with, guys. All right, last one. We'll wrap it up. GG. Same story. I mean, the bullish case has been made on all these, and boy, that was just a little nice fake out move, that falling wedge. But look at the resistance. We're up. It kind of clips those. We had, this was a meltdown period in 08 in the financial markets, so that line goes through there. But it really looks at these recent candlesticks, numerous reactions from above there, a breakdown, an impulsive move, which helps validate that support level. When you see an impulsive stick, once it breaks, came back tested. Now we're there again. Yes, we are flagging. Yes, we could take it out, but this one's solidly entrenched in, look at the white line, the 9 EMA on the PPO, still solidly in bear market territory. These divergences and everything say that, a likely trend change is probably around the corner, especially the fact we've already broken out. We put in that divergent low with a bullish falling wedge. Let's look at. Yeah, I wanted to we'll wrap it up here. I wanted to jump back to Barrick and just look at the the what if scenarios here. Okay, so going back to, as I said earlier in Barrick, this is the only thing even close to this rally in the miners in recent history, or probably in history period. I'm only going back 10 years here. Is this rally that we have here? Okay, this rally off the 2008 lows, came after the meltdown in 08, the 2008 lows, and then the miners started a very strong rally and a strong bull market, and it was, from the lows to the highs. And Barrick, I don't have the measuring tool here, but what I wanted to do is point out what happens after strong extended runs. So even if, let's say, this is the beginning of a new bull market, let's look at the first pullback in Barrick. We had that strong run up from here to here. What I'm doing, I'm putting Fibonacci retracement levels up. And as so often the case, pullbacks are typically contained within the 38. If you look to the left, we have a 38.50 and a 61.8 retracement. Those are the lines I like to watch. And that retracement was a 61. You can see it just stopped just a hair when, that was an intra-week spike too, right at the 61.8. So what would happen now? Let's just say this has been, again, the biggest run in history. So pullback is going to come sooner or later. And I really, like I say, I'm still favoring a sharp pullback. So let's just try to quantify things here. All right. A 31% retracement would take us zooming in here. This white line that I have here at 1016 is a horizontal. It was former resistance, now it's support. And you can see that's right between the 38 and the 50% fib retracement. Those are the dotted lines here. And then this is a 61.8, and that is a great, this is solid support. So, you know, you have to be open for the possibility, especially if the markets hold up, of a retracement, even if this is a bull market, as much as 60%, 61, the 61.8. And I tell you what, this to me would be textbook right here. You don't always get what you want. And the miners are notorious. I've always said this, for leaving you out when there's a rally or in a bear market, leaving the shorts out, letting them miss the opportunity. But this would just be so beautiful, because that would be a 61.8 retracement. It would come to this key support level. You see all these reactions here. This was really the base that we broke out of. And it would also come back and backtest the downtrend line. So quantify it. Let's try to measure it out. That would be I have to go to a different board here. From where we are today in Barrick, and remember, Barrick's the leader in the sector, so what it does, the miners will do as well, more than likely, give or take. So if Barrick were to drop from where we are today and come down to that level, which is about 850, you're talking a 37% drop. So you do the math on GDX or Nugget or Dust or whatever. So that's it. That's all I wanted to show. That's, you know, the most probable scenario, in my opinion, at this point, is a pullback to, you know, at least this area here, this 38% fib. There's some nice horizontal support just below that, as I mentioned, around 1016 or so. Maybe go down to the 50%, and that would make for a more lasting rally. It would also, if you look at it this way, I just now as I'm doing this, noting, you know, look at the potential for a nice inverse head and shoulders bottoming pattern on the weekly chart if we came back to that level. So this would be, here's your left shoulder right here. This is your head down here, and this would be your right shoulder. And then you would expect from that point, your right shoulder's formed. You would have a nice clear buy signal and a breakout of this major resistance that we're out right now. And that would take us up probably to that next target that I have up there around the 21, about the $22 area. So this is my ideal scenario again, and anything's possible. But if these things just keep going up like this, they'll just have to go up without me. That's all. All right, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.